Hi everyone, thanks for tuning into my channel, All Things Accounting. Today we are going to be dealing with earnings per share, in particularly how to deal with a 2-for-1 stock split and dividends. So stay right there and we'll go through this together. So earnings per share, one of my other tutorials I've looked at the basic computation of earnings per share. We went through a numerical example. That numerical example will form the basis of the example of what we're going to be going through today in order to cover the concept of what happens to weighted average common shares outstanding when there is a 2-for-1 stock split, as well as when there's dividends declared. How would that affect the equation? So let's look at the setup here. This is similar to, actually the same as last example if you had tuned into my earnings per share basic computation, the basic earnings per share tutorial. So we're assuming here if there's 50,000 preferred shares at $5 cumulative, if net income is $880,000, if on January 1st, 500,000 common shares were outstanding, on April 1st, an additional 40,000 common shares were issued. And then on November 1st, the company had repurchased and retired 30,000 common shares. So when there's a dividend or stock split, what happens is that it affects the weighted average common shares computation. So the way we handle this is that we have to restate the number of common shares outstanding during the year to reflect the split and dividend as if it had occurred at the beginning of the year. So because we know this, it's going to affect the denominator. So over here, earnings per share is equal to the net income minus the preferred dividends. And remember, this is dividends declared during the year, or if it is cumulative, divided by weighted average common shares outstanding. So in here, the preferred dividends that we will compute is 50,000 preferred shares multiplied by $5, which will yield $250,000. Okay, so now let's assume here on December 1st, 2021, the company had declared a 2-for-1 split. Meaning that if you had held one common share before, now you have two. So that would tend to normally dilute the value of the common shares, because now in the denominator you have more outstanding common shares. If the denominator gets larger, holding all other factors consistent like net income and the preferred, basically the numerator, if the denominator gets larger, then the whole outcome would get smaller. So that's what we call dilution. So if we were to look at this, how would we handle the declaration of the 2-for-1 stock split? So let's draw a line here. For January, let's say for January to March, we know that there was 500,000 common shares. So 500,000 common shares times 2, because there was a stock split, and that's for 3 months. So multiplied by 3 out of 12. Now, from April to November, now we know that they had issued an additional 40,000 common shares. So in total, it's 540,000 common shares multiplied by 2, multiplied by 7 months out of the 12, from April to November. Now for November, on November 1st, when they had repurchased and retired, so basically this is going to be 510,000, because it's 540 minus the 30,000, multiplied by 2, multiplied by 1 month out of 12 months. And then on December when the 2-for-1 stock split was declared, this would basically be 510,000 multiplied by 2. So basically, that's for that. This would yield 1,020,000. Okay, multiplied by 1 out of 12. So notice in the month of December, we're multiplying it by 1 because we already took into account the split here. So we're doubling it up here. So that's why we multiply by 1. So if we compute this, this would equal to 250,000. This would be equal to 630,000. This would be equal to 85,000, as well as this. So 85,000. And if we sum it up, it would give us 1,050,000 common shares. So if we were to look at this and compute the basic earnings per share, in this case, if we were to compute this, it would be $880,000 minus the preferred dividends of $250,000, all over 1,050,000 common shares. So then that would equal to 60 cents per common share. So that's how we deal with it. We're assuming that the split would have happened at the beginning of the year. And that's why we're taking the weighted average here, multiplying that 500,000 and finding the weighted average. So that's the case where it is a stock 2-for-1 stock split. Let's examine how it would be impacted if there was a dividend that was declared on these stocks. So now let's have a look at if there was a 10% dividend declared. So instead of a 2-for-1 stock split on December 1st, 2021, the company declared 10% dividend. So how would that affect our computation? Well, let's go through this. Let's go through from January to March. Again, originally we had 500,000 common shares. Now, if we had a 10% dividend, we multiply that by 1.10, and we multiply that by 3 months out of the 12 months of the year. That would give us $137,500. 137,500 common shares, the weighted average. Let's say from April to the end of October, so April to October, end of October, we know that because the company had issued an additional 40,000 common shares, we're treating that as if the dividends was declared at the beginning of the year. So 540,000 multiplied by 1.10 multiplied by 7 months out of the 12 months of the year. So then that would yield 346,500 common shares. Now for November, we know that they had repurchased and retired 30,000 common shares. So that's going to be giving us 510, because it was 540,000 minus the 30,000 multiplied by 1.10 multiplied by 1 month out of the 12 months of the year. So that would give us 46,750 common shares. Now, for December, on December 1st, what happens here is that we know that they declared a 10% dividend. So in this case, it is 561,000. So why is it 561,000? Well, 561,000 because if we took 10% of 510,000, 10% of that is 51,000. So 51,000 multiplied by 51,000, add that back to 510,000. So This here would be a result of 510,000 multiplied by 0.1, which gives us 51,000. And then we take that and we add that back to 510,000. That gives us 561,000. That's how we come up with the 561,000 multiplied by 1, because if we're accounting 561,000, we're already accounting for the change for the month of December already. So multiplied by 1 month out of the whole year. So that should give us the same amount, 46,750. So the summation of all that would be 577,500 common shares outstanding. So if we wanted to look at the impact of that on earnings per share would then equal to $880,000 minus the preferred dividends of $250,000, all over 577,500 shares. So what that would give us would be $1.09 per common share. So I hope this tutorial helps a little bit in terms of understanding what the nature of stock splits are, as well as what happens to the equation of the basic earnings per share and how the weighted average common shares outstanding are affected when stock splits are declared and dividends are declared. So if you like this tutorial, please subscribe to my channel. Please hit the bell notification icon so that you'll always be up to date on my new tutorials that I'll be posting, and hit that like button. So until next time, take care.